Hey guys, today we will be taking a look at software as a service stocks. And if you have never heard of this concept before, it might be a good business model to get yourself familiar with because this is a segment of the market that is experiencing huge growth right now. In fact, if we look at my M1 Finance portfolio, which is my main investment portfolio, you can see that I have 25% of my money going into these software as a service companies right now. And if we look inside of this software as a service pie, we can see that I have nearly 20 stocks in here. These include stocks such as Adobe, Paycom, Zoom, Okta, and Fastly. And if you have watched any of my other videos, you would know that Shopify, which technically is considered a software as a service company, makes up a big percentage of my investments. So this video will be organized into 3 different parts. The first part will be a history of software companies and why the software as a service business model is great for not only companies, but also end users. Second, we will look at how to quickly analyze these stocks to see which ones have the highest potential. And third, I will give you my top 5 picks for stocks in this space. So if you are new to the concept of SaaS companies, I would recommend watching the entire video. But if you instead came just for the picks, then you can skip to the end. Now, one of the reasons I have so many of these stocks in my portfolio is because there are so many different applications for these software as a service companies. SaaS stocks are basically companies that host their software on servers that make it available for customers to access using the internet. These types of stocks make good investments because they have both recurring revenue and high profit margins. Now, companies that sell software have been around for a long time, but a lot has changed over the years, and the internet is the one thing that has allowed software companies to really change up their business models. This is because before the internet, software companies like Microsoft and Adobe only sold physical copies of their software, meaning you had to go to the store, buy a CD with the software on it, and then install that software on your computer. And some of you watching this might be young enough that you have literally never done this before. But for me growing up, the only way to get Microsoft Word on my computer was to buy the CD. Now, this was a good business model for software companies, but it had some issues. One of those issues was that once a person bought the CD and installed the software, there was really no way to make that person upgrade when the latest and greatest software was released. What this meant was that software companies had to charge a lot of money for their products since it was not a recurring revenue stream. However, the high price that software companies like Adobe were charging also meant that people were less willing to upgrade every time new software was released. So what these software companies like Microsoft and Adobe started doing was instead of selling the software directly to consumers, they started licensing it. What this meant was that for a low monthly fee, you could download and use the company's software. Now, when Adobe announced they would start doing this back in 2012, many people got upset because what it meant was that they would now have to pay for the right to use the software for basically forever. But I think this reaction was primarily driven by people's natural inclination to hate change. I mean, let's be honest, people throw a fit every time Facebook decides to change the shade of blue they use on their website. Now, the reason I say this is because people who actually compared the costs over a short period of time, like 3 years for example, found that Adobe's new subscription model actually ended up costing less than actually buying the software outright. Another good thing for customers, even though they were resistant at first, was that instead of needing to pay thousands of dollars all at once for the software, they could instead pay a low monthly fee. And this was also good for the company because it meant that they would get a recurring stream of revenue on a consistent and predictable basis. This is good for companies in the same way that it is good for households. Getting a regular paycheck is good because you always have money coming in, and you don't run the risk of running out of money and not knowing when you will be paid next. And when it comes to companies, consistent revenue is also good because as a publicly traded company, you have to report earnings 4 times a year. So being able to show stable revenue growth is really important. And it helps investors gain confidence in your stock and makes them more willing to buy. An additional benefit for Adobe was that they did not have to ship out physical CDs, which helped them cut costs. But not only that, Adobe also was able to add on additional services like cloud storage of files. And this is a big potential source of revenue for software as a service businesses. In fact, Apple reported that it generated $13 billion worth of revenue in Q3 of 2020 just from the software and services segment of its business, which does include iCloud. So as sales of iPhones slow down, even Apple will start relying more and more on the software as a services side of its business. And for Adobe, this switch from a traditional software business model into a SaaS business model resulted in a positive effect on the company's stock. Despite announcing the shift in 2012, Adobe waited until 2017 before completely switching over. And if we look at the chart for Adobe, we can see that around November of 2016, the stock began to grow more aggressively. In fact, from November of 2012 to November of 2016, Adobe stock advanced 214%, which is a really good rate of return for a 4-year period. But if we look at November of 2016 up to today, we can see that Adobe has advanced almost 350% in less than 4 years. So for me, once I saw this in the chart of Adobe stock around 2017 and 2018, I decided to buy a lot of the stock in my retirement portfolios, and it has been a great investment for me over the past couple of years. But the whole point of me focusing so heavily on Adobe stock in the beginning of this video is to show you that having a software as a service business model is not only good for companies, but it is also good for end users, as it gives a better user experience and is cheaper. So the next part of this video, I want to focus on how we, as investors, can easily and quickly evaluate these SaaS stocks. And the good thing about the strategy I will share with you is that it relies on financials. So it doesn't require subjective criteria that are difficult to determine, but rather relies on numbers. Now, usually I am not a fan of just relying on financials, even though I do believe financials are very important, but it is the best way to evaluate these SaaS stocks for a number of reasons. One, SaaS stocks are a lot more difficult to understand for the average investor. I recently did a bunch of research on Fastly stock, and in order to understand their business model, I had to learn a bunch of jargon that was very confusing. Now, for someone who has a degree in computer science, I'm sure it would not be too difficult to understand what Fastly does. But I do not have a degree in computer science, so I really hadn't heard of things like CDNs, nodes, reverse proxies, and so on and so forth. And it's funny because I was watching a YouTube video of someone giving a presentation on Fastly services, and he literally said something along the lines of, "This is similar to a reverse proxy." But I won't explain that since we all know what a reverse proxy is. So trying to completely understand what each of these SaaS companies do before buying them is not the easiest thing to do. So having objective criteria like numbers from financial statements is very nice. So what is this rule? Well, it's called the rule of 40, and it is calculated by taking a company's revenue growth, which is a percentage, and adding it to the company's earnings before interest, taxes, depreciation, and amortization margin, also called EBITDA margin. If the sum of these two numbers are above 40, then this is a stock with high growth potential. And if the number is below 40, then it is a stock that we want to do more research on before buying. Now, the rule of 40 is just a guideline, and it is just one of many ways that you can value these SaaS stocks. But like I said earlier, it is a very quick and easy way to screen through the hundreds of SaaS stocks that are out there. For me, when it came to selecting which SaaS stocks I would add to my portfolio, I decided to diversify my holdings and buy a lot of different SaaS stocks. Now, this isn't really true diversification because even though I had close to 20 different SaaS stocks in my portfolio, they all tended to move up and down together. So diversification in this case did not help me when it came to volatility, but it did help me reduce my risk of picking a SaaS stock that could go bankrupt. That's because each SaaS stock only makes up around 1.25% of my portfolio. Also, it's hard to know which SaaS stocks will outperform all the others. So my goal is to try and hold as many of the top performers as possible, while at the same time avoiding the low performers. And since there are so many of these software as a service companies, I want to break down my top 5 picks by market cap. So what we will do is look at the top 5 SaaS stocks with a market cap over $50 billion. Then we will take a look at the top 5 SaaS stocks between $10 billion and $50 billion market cap. And last, I will give you my top 5 that have a market cap under $10 billion. The benefit of doing it this way is that you can pick and choose your own SaaS stocks from my list based on your risk tolerance. The largest stocks will be the least risky, and the smallest stocks will carry the highest risk. So if you want to take on more risk for a higher potential return, then you can pick the smaller stocks in my list. But if you have a very low risk tolerance, you can stick with the larger SaaS companies. To do this, I will be using M1 Finance's stock screener, and I have filtered through the companies so that it only shows SaaS companies. Also, I have set the minimum market cap up in the corner to be 50 billion or more. Based on the filters I have selected, there are only 9 stocks to choose from. And as you can see, based on the stock returns over the last 5 years, Adobe has the highest return with a 39.77% annualized return, which is very good. Next, you have Autodesk, followed by Microsoft, Zoom, Intuit, and Salesforce. Based on the 5-year returns of these stocks, it looks like any of these 6 stocks would be a good investment, but the top 4 are all above 30% annualized returns. So I would probably stick with these over Intuit and Salesforce, which only had 20% 5-year returns, annualized that is. Something else that stands out to me is that Microsoft looks to be the best risk versus return ratio here. It is a $1.6 trillion market cap stock that has been able to grow by 33% a year for the past 5 years, which is very impressive for a stock of its size. Okay, moving on to SaaS stocks in the $10 billion to $50 billion market cap range. In this range, you can see that there are 27 stocks. And if we sort them by the highest 5-year annualized return, you can see that the top stocks in this section have much higher returns than the stocks we just talked about. But what's interesting here is that only 10 out of the 27 stocks have higher returns than Microsoft did over the past 5 years. So holding a smaller company is no guarantee that it will outperform a larger company stock, such as Microsoft. But we can see here that the top performers in this section do have considerably higher returns. I would personally recommend buying all of the top 8 in this section, but if I had to choose 5, I would probably go with Viva and Paycom as my top 2, followed by Okta, Twilio, and Team. I like Viva and Paycom the most because they are actually profitable right now, which is a really good sign in my opinion. And keep in mind, these SaaS companies don't need to be profitable to satisfy the rule of 40 because a lot of these companies have very high revenue growth. But at some point, they will need to become profitable to have a sustainable business. Now, I also own Coupa Software and RingCentral in my portfolio because they are very high performers. But I do like stocks like Paycom, Viva, and Okta because I like their business models a lot and they each service different sectors of the market. So there's a lot more I could get into here, but this is more of a high-level overview, so I am keeping it vague on purpose. The next section of SaaS stocks are those with market caps under $10 billion. These are the SaaS companies that will be the most risky. And in my opinion, I think it's best to stay out of this market cap range. There are 91 stocks in this section, and it's very difficult to pick the winners. The software as a service segment of the market is very competitive, and it has a fairly low barrier to entry. So what this means is that a lot of very small SaaS companies will fail. Also, if we sort these stocks by their 5-year annualized return, we can see that the returns on these stocks are not that great. In fact, only 5 stocks in this category have higher 5-year returns than Microsoft. So in terms of risk versus return ratios, you can see how good of an investment Microsoft has been over the last 5 years. Now, despite the risky nature of these stocks, I do own one of these stocks in my portfolio, and that is Alteryx. And as you can see, Alteryx has performed very well over the past 5 years. But when it comes to Alteryx, they did have disappointing earnings, which caused the stock to drop 40% over the past week. One more thing I do need to mention is that there were some stocks that I did not bring up in this video that are technically considered SaaS companies. Shopify and Square are considered by many to be SaaS companies, but it's not the only thing they do. So for me, I like to only include pure SaaS companies in the SaaS pie of my portfolio to make things easier. But for you guys, you can categorize these stocks however you like when you add them to your portfolio. If you guys enjoyed this video and you would like more detailed analysis of individual SaaS stocks, then comment below with the stocks you would like me to cover. Also, if you enjoyed the video, make sure to subscribe. It's really easy to do and it helps the channel out a lot. Also, if you are still watching, there are videos on the screen that might interest you, so feel free to click on one of those now. And with that, thanks so much for watching, and I'll see you guys in the next one.